In July 2015, the FASB issued Accounting Standards Update 2015-12, which will reduce costs and complexity for employee benefit plan financial reporting, specifically presentation and disclosure requirements. This ASU is a consensus of the FASB's Emerging Issues Task Force. Welcome to the KPMG Podcast on ASU 2015-12, Employee Benefit Plan Simplifications. My name is Dan Amat. I'm joined by Robin Van Voorhees. We are both senior managers in KPMG's Department of Professional Practice. During this podcast, we'll provide some background and an overview of the new ASU. Robin, before we begin, can you clarify whether this ASU addresses financial reporting for plan sponsors or the plans themselves, or is it both?
Sure, Dan, that's a great question. And this standard only addresses financial statements of employee benefit plans, which include defined benefit pensions, defined contribution, and health and welfare benefit plans. So the financial statements of plan sponsors are outside the scope of the new standard.
Okay, thanks for clarifying that. So can you provide us a brief background of the new standards update and why it was brought to the EITF's attention in the first place?
Sure, Dan. So in March 1980, so over 35 years ago now, the FASB issued statement number 35 about defined benefit pension plans. In 2009, the FASB issued its codified standards, and statement 35 became the basis for the FASB's 3 plan accounting topics, which include topic 960 about defined benefit pension plans, topic 962 about defined contribution pension plans, and topic 965 health and welfare benefit plans. So very few changes have been made directly to the plan accounting topics since issuance of Statement 35, but other standards have been added or updated over the years, and as a result, additional disclosure requirements have become applicable to employee benefit plans. And one big hitter is Topic 820 about fair value measurement, but I'll get into that a bit later. So like its name, the overall objective of this EITF issue was to address redundant disclosure requirements and also to simplify certain other measurement and disclosure requirements for plans while always maintaining or improving the usefulness of information provided to users. I should also mention that this one ASU is actually comprised of 3 separate parts, so we can discuss each of those one at a time.
Okay, so let's start with the first part of the ASU about fully benefit responsive investment contracts. So what are these exactly?
So an FBRIC is a guaranteed investment contract between the plan and an issuer, and generally that issuer is an insurance company or some other financial institution, in which the issuer agrees to pay a predetermined interest rate and principal for a set amount deposited with the issuer. Now, those investments are owned by the issuer rather than the plan, so the issuer is the one accepting the interest rate risk. To qualify as an FBRIC, an investment contract must meet a list of criteria, which are outlined in the FASB's definition of an FBRIC in its master glossary. The definition of an FBRIC requires all permitted transactions to occur at contract value. So if an event occurs such that realization at full contract value is no longer probable, then the contract would no longer meet the definition of an FBRIC and it must be measured at fair value. So current guidance requires that all investments that meet the definition of an FBRIC to be measured at fair value with an adjustment to contract value on the face of the plan financial statements. But stakeholders have argued that contract value is the relevant measurement for these contracts because that is the amount participants would receive if they initiate permitted transactions such as withdrawals. So all in all, the EITF decided to eliminate the presentation and disclosure requirements related to fair value measurement for fully benefit responsive investment contracts. So now contract value would be the only required measurement for these investments. Also, FBRICs will be reported separately from investments at fair value as either investments at contract value or fully benefit responsive investment contracts at contract value. The EITF also decided that the final standard should address some questions that were raised about synthetic guaranteed investment contracts that meet the definition of an FBRIC, and also clarify that FBRICs held in a master trust are subject to the same presentation and disclosure requirements as FBRICs held by a plan.
Okay, thanks, Robin. So let's move on to part 2 then.
All right, so this next part addresses that interaction between Topic 820, fair value measurement, and the plan accounting topics. And there are a number of areas here of overlap and duplication, so the EITF really just tried to eliminate some of those redundancies. So first, the EITF decided to eliminate the Topic A20 requirement to disaggregate investments by nature, risk, and characteristics. So under the new standard, plans will only need to disaggregate investments by general type. Additionally, self-directed brokerage accounts will now only be one type of investment. This will provide consistency with the level of disaggregation provided by most trustees, custodians, and insurance companies, and with the information required in the Form 5500 that plans file with ERISA. Second, the ITF decided to eliminate the plan accounting topics requirement for plans to identify investments that are equal to or greater than 5% of net assets available for benefits. Additionally, the ITF discussed certain required disclosures for investments measured using the NAV or net asset value practical expedient, and decided that only investments in a fund that separately files a Form 5500 with ERISA as a direct filing entity would no longer need to disclose significant investment strategies for these types of investments. And last, the ITF decided to eliminate the plan accounting disclosure requirements to disclose net appreciation, depreciation by general type of investments. But plans will continue to be required to provide a level 3 roll forward for investments that are level 3. I should also mention that investments that are held in a master trust will be subject to the same presentation and disclosure requirements as investments held in a plan.
Can you tell us at a high level how the EITF came to these retain versus eliminate requirements?
Sure. So I would say generally the EITF's decisions are consistent with how plans report their investment information to its primary regulator or the Department of Labor. And also in the EITF's view, the cost to maintain certain requirements just really outweighed the benefits to users.
Okay, great. So how about part 3 and then the effective date?
So this final part was added to the EITF's agenda in light of a recently issued accounting standard update, which allows employers to measure defined benefit plan assets on a date that is near the employer's fiscal year end, when the fiscal year end does not coincide with a month end. So as a result, employers are able to measure the fair value of plan assets using information provided by third-party service providers, which is typically provided as of a month end. In response to this relief for employers, the EITF decided to extend a similar practical expedient to employee benefit plans. In addition, plans would be required to disclose contributions, distributions, and significant events that occur between the alternative measurement date and the plan's fiscal year end. Also, this ASU applies only to investments and investment-related accounts. It doesn't provide a practical expedient for measuring the plan's benefit obligations, so plans will continue to follow current guidance and measure obligations at the plan's year end.
Great, thanks, Robin. Can you tell us about transition requirements when this new standards update is effective?
Sure. So for part 1 about FBRICS and part 2 about plan investment disclosures, transition will be retrospective. And for this final part, the transition will be prospective. The new standard is effective after December 15, 2015. So for calendar year plans, it is effective for their 2016 financial statements. Early adoption is permitted and encouraged.
Thanks, Robin. For more information on ASU 2015-12, please refer to our Defining Issues publication, which summarizes the EITF's discussion and the new ASU itself. The Defining Issues is available for download at KPMG's Financial Reporting Network. Thank you for listening.